All right, guys, we're going to look at closing transfers. You'll see we'll also introduce the final accounts, the profit, loss, and trading account in this lesson. And I'm using an example exercise from your textbook to go through this with you. First of all, gents, if we have a look at the year-end procedure, what we've done here is we've had a look already at the pre-adjustment trial balance. We've dealt with recently all the adjustments. After those adjustments, we've drawn up the post-adjustment trial balance. And now you'll see the section we're moving on to is what we would refer to as closing transfers. So let's have a look at what that entails. Okay. Closing transfers, guys, first of all, is knowing what is the reason for closing transfers. A business wants to determine its profit. And one of the ways of calculating the business's profit is obviously taking the business's gross profit and then adding income and subtracting expenses. So if we have a look at that, guys, your gross profit is sales minus cost of sales. And you'll see we do that calculation in a new account called the trading account, which is a final account. And then you'll see that profit and loss account is where you will draw up that incomes minus expenses. That all goes to the profit and loss account, which is another form of final account, which you'll see shortly as we go through this little video. The steps involved, gents, with regards to closing transfers, you'll see there are 8 steps involved here. You can see the first step, you transfer debtors allowances to sales, and then you go through the next 7 steps from there, and we're going to go through them step by step with you now in this video. When we finish this process, you'll notice all the nominal accounts will be closed off, and you'll see in the last slide, I'll explain to you what the post-closing trial balance is and what it looks like. In our first step, guys, you'll see here we transfer debtors allowances to sales. You'll see here debtors allowances obviously reduces sales. So that's the very first step in closing transfers, is that debtors allowances gets closed off to sales. So if you have a look here, debtors allowances will be credited, and then the sales account gets debited by that amount, 455 Rand. In our next step, gents, step 2, we then transfer cost of sales to the trading account. So you'll see here to transfer that cost of sales to that trading account, you'd have to credit cost of sales by that amount of 132,000, and then the actual trading account gets debited by that amount as cost of sales 132,000. In our third step, following through our steps here, you'll see here we close off, or we transfer sales now to the trading account. So you'll see we'll debit sales by that amount of 176,000 Rand. You can see we obviously had to balance sales to get to that figure, and that amount gets closed off to trading account on the credit side, 176,000 Rand. Then our fourth step, guys, we calculate gross profit, and we transfer this profit. We transfer this to the profit and loss account. So you can see what the trading account looks like now. It has a debit balance of 132,000, which was that cost of sales that was closed off the trading account. And then on the credit side, we've got that 176,000 Rand, that sales amount that was closed off. Okay, remember, gents, don't forget to close off debtors allowances first. Sales figure must be the new adjusted figure with debtors allowances removed from it already. We then balance the trading account, and that will calculate our gross profit. So in balancing that, you'll see that the gross profit figure is actually 44,000 Rand that the business has made here. And that profit of 44,000 Rand must go to the profit and loss account. And you'll see it goes onto the credit side. Okay, so that's your fourth step. In our fifth step, guys, what we need to do here is we need to close off all our income accounts going to the profit and loss account. So if you have a look here quickly, rent income was given to us. You balance that account, so you're going to debit rent income by 4,800 Rand, and you'll see the profit and loss account gets credited by 4,800 Rand. Same thing, we balance the interest on fixed deposit, and you'll see there we'll have to debit interest on fixed deposit to close off that income to profit and loss account by crediting profit and loss by that 1,200 Rand. So that's our fifth step. In our sixth step, we have to close off all our expenses. Okay, those expenses also get closed off to the profit and loss account, and you'll see now when we go through that process with you what that looks like. In our first step, you'll see salaries is the first expense. We credit salaries. By crediting salaries, we then need to debit it in profit and loss. Remember again, double entry principle. For every debit, there's an equal credit. In this case, obviously a credit. The debit entry is in profit and loss as salaries. You'll see insurance there. The amount there is the credit amount of 600 Rand, and then we have to go and debit that into profit and loss. Bad debts, 540 Rand, and we debit in profit and loss. Water and electricity, credit that account by 365 Rand. We debit profit and loss by 365 Rand. And then you can see that depreciation account. You're going to credit depreciation, and then the debit entry will be in profit and loss account. So what you can see now, gents, what we've done in these last steps 5 and 6 is we've closed off all our incomes to profit and loss, and we've now closed off all our expenses to that profit and loss account. We can then move on to our next step. In step 7, what we need to do here is we need to calculate the net profit. And remember, who does the money belong to? The profit belongs to the owner. So you can see that when we transfer that net profit, it gets transferred to the capital account. Okay. So in this step, you'll see the profit and loss account there in front of us. You're going to balance the profit and loss account, and you'll notice that the capital, which is now the calculation of that net profit, is 24,940 Rand. So you can see we've gone and debited 24,940 Rand in profit and loss. That means in the actual capital account, because this was a profit the business has made, the capital account is going to be increased by that amount of 24,940 Rand. Guys, in this example question in your textbook, there wasn't a balance given to us for capital. So that's why I just showed that the other balance for capital would have been there. Also in this exercise, in this example, there wasn't an amount for drawings, but in your final step with closing transfers, you'll see step 8, you would then close off drawings to the capital account as well. So that's your final step here as a closing transfer. If we had a debit amount for drawings, you would have then credited drawings by that amount, and then that's how you would have got it into capital by debiting the capital account. Okay, guys, so that is our 8 steps to closing transfers. I'm hoping it's a nice, simple explanation for you guys that you can follow in your textbook again, and hopefully there's a better understanding of it. Finally, you'll see the post-closing trial balance. After completion of the closing entries, all the accounts in the nominal account section of the post-adjustment trial balance are closed. So now the nominal accounts no longer exist because they've all been closed off. Only the balance sheet accounts, with the exception of drawings, remain open. Okay, in this case, in step 8, we closed off drawings already. Okay, these figures are used to draw up a post-closing trial balance. Okay, and that, gents, will get you to the next section of work by doing that next activity that I've given to you.